This is Scott Becker with the Becker Private Equity and Business Podcast and the Becker Business Minute Podcast. I am thrilled today to be joined by Amber Walsh. Amber lives at the intersection of healthcare and private equity. She also serves on the executive committee of McGuireWoods after years of serving as leading the National Department in Healthcare. A really magnificent lawyer in person. Kudos to her, who has a son who's now going to Johns Hopkins. But we're not going to talk about any of that today. We're going to talk today about what she's seeing and what she's hearing in the healthcare private equity deal environment. Amber, take it away. Congratulations on all your success, and tell us what you're seeing this year in the healthcare deal environment.
Thank you, Scott. Well, it's always fun to have this first kickoff conversation of the year. And it's often surrounding the JP Morgan Healthcare Conference that many industry participants are aware of or have attended. And I always love the timing of the conference. It tends to get people together, get people re-energized, and before the official deal-making metrics start to get reported on Q4 from the prior year, JP Morgan often serves as a forum for people to share their year-end experiences, do forward-looking for 2025. And really, that includes the vast majority of the people who are out in San Francisco right now who are not actually attending the conference, but are doing all of the other events around the conference. The conference itself, this is the 43rd year for the JP Morgan Conference. Conference itself really only has a couple hundred panels and a few thousand attendees, but the estimates every year are that there's an additional 50 to 80,000 people that pour into San Francisco to have these surrounding meetings, bringing in about $1 billion to San Francisco for that 4-day period. It's pretty wild. And this year, as in all years, it's a great way to kind of track the conversations and see how people are feeling and what they're expecting. It is an interesting dynamic this year where I am not physically there this year. After having attended for 10 years, I'm not physically there this year, but all the reports from our colleagues, our clients, and all the reporters are that, especially coming out of the Brian Thompson murder and a lot of the sensitivities around for-profit healthcare, that San Francisco's really cleaned up for this event, added a lot of security that you have not seen in the prior 42 years. And there's some kind of regulated protesting that's going on. So it's a little bit of a different dynamic, which, still hasn't answered your question, Scott, about what I'm seeing, which I'm happy to talk about. But I always think it's just fun to talk about JP Morgan because it's just a little bit different every year, but an important way that we all kind of kick off our year for healthcare deal making.
I mean, 100%. It's fascinating, too, that they've got protests out there. It's amazing how this whole world of healthcare has evolved and how insane it has become. But what are you hearing in terms of the deal market, the deal environment? Of course, so many people got to JP Morgan thinking about what that deal environment is going to look like this year. And you're right, JP Morgan's becoming this incredibly large gathering. It's like the Woodstock for healthcare deal making. Tell us what people are saying.
Yeah, absolutely. Maybe slightly less cool than Woodstock, but pretty close. So throughout 2024, we all expected, I think, a little bit of a sharper, faster ramp up in healthcare deal making. Obviously, we're all aware that 21, 22 were really huge record-breaking years in healthcare private equity deal making. By the end of or middle of 23, for a lot of reasons, and into early 24, it had really slowed down quite a bit. It picked back up in 24. It did not pick up as swiftly as we all expected. But the feeling is that by the very end of this past year, so we're talking about just this past November and December, it really picked back up, particularly after the election, some important rate decreases, some indications that maybe some of the tighter regulatory environments were going to loosen up a little bit with new administration next year. Deal making really did pick back up at the very end of 24. Now, the official reports that Prekin and PitchBook and Bain always publish, they're not out yet, but that was our sense at McGuireWoods. It's the sense from everybody at JP Morgan is that they had spiky year ends, some deals that had been put on ice for a while, either due to HSR with the FTC or due to some insecurity in their lending relationships. Those got over the line at the end of the year. And people are expecting that to continue, that all of these things that had kind of constrained M&A activity in healthcare private equity longer than we thought throughout 2024 have loosened up, and we're expecting more deal volume. However, it's also in specific areas. I think there continues to be some private equity investor reticence about physician practice management companies. There are several that did really, really well in their exits at the end of last year. There are several that are on the market now who really have performed well. And I know there are some being talked about out at JP Morgan. You know, the investment bankers kind of take them out to market sometimes at JP Morgan. So it's still happening, but not with the same pace that investors had been interested and excited about in that particular space, physician practice management. Where there is interest in physician practice management, it's particularly, I think, enthusiastic in areas like we're seeing a lot of cosmetics, med spa, things that have no Medicare, Medicaid, you know, a little bit lower reimbursement risk. But all of this kind of reticence about PPM world, physician practice management, is expected to kind of even out in 2025. And then, of course, there are, you know, other things I can share as well, but that's kind of the general outlook of the picking back up, a little bit less still, slower to come back in physician practice management, more interest in other areas like pharma services, lots of tech-heavy private equity-backed companies and first institutional capital, but general enthusiasm and hoping very much and expecting that 25 is going to be much bigger than 24.
Yeah, no, fascinating. And when you see like the healthcare PE space, do you see differences? It's still a delta between what buyers and sellers are looking at for deals. What are people saying there about valuations?
Yeah, definitely. Definitely still valuation gaps persisting. I think that their advisors, financial advisors, their lawyers, CPAs, investment bankers are trying to, and have been for the past 18 months or so, reset seller expectations. And the gap is narrowing, but there are still reports, and I'm seeing it as well in the deals where we get to experience from the very beginning of the process all the way through the choice of the buyer and conclusion. We see it happening more still now than it used to happen, where sellers come in with an expectation of higher value, premised on the deals they saw get closed in their space in 19, 20, 21, 22, where valuations have kind of plateaued out just a little bit. And that seller expectation gap from what buyers, and even more important, buyers who are using leverage, particularly those using traditional banks, that does persist. And so that is having a continued constraint a little bit on deal making. What it seems is happening more often than not, though, is that it just narrows down the buyer field much more rapidly, so that our processes that we're following are, instead of having 18 super enthusiastic buyers that connect with the seller's valuation expectations. And instead of having, in the teens, you get down pretty quickly to a much narrower group. And so deals are still being made on a lot of other reasons beyond valuations, but because of those gaps that do persist, you are having more kind of limited universe of deal players.
Fascinating. Let me ask you another question. The deal world, a few years ago when it was truly a seller's market, you would see extremely clean term sheets because the buyer was trying to prove to the seller, we're closing and we're ready to close, and don't worry, we're not going to mess around. It seems like currently, like I'm just reviewing a term sheet that came across my desk, and nothing seems that clean and easy as it did a few years ago. Amber, you're much closer to this than I am day to day. What is your sense of that?
And that's absolutely right. I think that's a really great observation, and it's absolutely true that buyers are kind of getting away with more conditionality to, even if you have a two-step sign and close, even conditionality between signing and closing, giving more discretion to buyers to get really, really comfortable in diligence and to run a very intricate change of ownership process in whatever their area is. And giving buyers, a little bit more flexibility to make sure that they're hyper comfortable. And again, I mentioned earlier, those buyers who are using debt for the acquisition, particularly if it's a traditional bank, there's a lot of outs, financing outs, et cetera. And that does make sellers a little bit nervous, a little bit less secure. It also has opened the door more for private credit. So you are seeing a lot, and you're hearing back to JP Morgan, there's a lot of discussion about private credit kind of coming in to fill the gaps where traditional banks may just have higher standards to make the loan, take the risk on the investment. Private credit is coming in to fill the gaps, which is exciting as well. But yes, all of these things are happening. And so, of course, when one dynamic happens, like, buyers getting a little bit more nervous and, adding more conditionality, you have these resources like private credit, or a couple of years ago, the emergence of RWI carriers. They came in to kind of soothe it and make sure that sellers could still get comfortable and deals can still get done.
Thank you. Talk about two other issues. How are the discussions of artificial intelligence in these acquisitions? It seems like on the hardcore practice side that maybe it's less of an issue, but generally, how are people thinking about AI and where that's going to have impact? I guess another question is, people still looking for organic growth versus bolt-on growth? And then a third issue is just sort of the onslaught of Dr. Oz and RFK. I know I said two issues, but let me give you three. AI, the new administration, and platform growth versus bolt-ons. What are you seeing and hearing there?
Yeah, that's a great discussion point. I feel like, particularly where I live personally, some of my other colleagues, as you know, Scott, some of our other partners do a lot more themselves in actual, technology, FDA life sciences investing. But even for me, who is dominantly private equity investing in services, traditional facilities, practice management, dental, vet, et cetera, even where I live, there's not a single deal conversation that happens or a single platform growth conversation that happens, or even compliance, that doesn't eventually touch on AI. And it comes up in a lot of different ways. Of course, it comes up in what investment should we be making? What should our buyer partners be providing in terms of access to the newest technology? How should we incorporate this into our platform? It also comes up in how you get a deal done and new uses of AI in just the deal making process. We're using it at the firm. Most law firms are. We have to be particularly careful about it, and we're very, very disciplined in what we can use because you have all sorts of client confidentiality issues. But it's a constant buzz in the background and often comes to the foreground of discussions of how to grow the platform, what is expected of the platform post-closing, how do you get a deal done using AI? It's just a constant part of the conversation. And I feel like there's just a lot of noise. So when I use the word buzz, it was intentional because there's a lot of noise. It can be confusing, and it's just something that we all kind of have to figure out because it's not going away. It's part of our world. It's part of how we get deals done. And even lawyers who tend to be the most conservative in using new tools, we got to figure out how to do it and how to guide our clients through it. So it is a big part of the discussion.
I mean, 100%. And talk about, for example, what are you most excited about this year when you look at the deal world, the deal environment? Where are you most excited, Amber?
Yeah, I'm super excited in, honestly, the use of traditional facility platforms and investments and how they continue to be such a big part of how health systems and PPM businesses and large physician practices serve their patient base, including in partnership with some insurance companies, with different provider types. I'm very excited about that. This has been going on for decades where you've seen obviously different players, different stakeholders coming together, hospitals, physicians, surgery center companies, insurance companies coming together. That's been going on for decades. What I'm really excited about personally, because of where I live in the ecosystem, is I'm excited to see how the Strikers and the Zimmers and the large value-based care physician groups can come together in surgery center investments and make something that is a really cool product for patients that works really well for insurance companies to lower costs. That's what I'm really excited about. It's something that's been talked about for a really long time. It's not a big driver of M&A, but it is a big driver of building something better for patients that everyone can, generally get on board with if you can get through all the regulatory hurdles of bringing together all those different stakeholders. So for me, I'm really excited about that. At the same time that I do expect the traditional M&A that has been going on for years that we expect to bounce back at the same time that we're doing that. I'm excited to kind of do both and follow both, kind of the build from scratch and the M&A. I'm excited to do that throughout the year.
Fascinating. Amber, as always, it's fantastic to visit with you. You've got a better head on your shoulders than almost anybody I know in the world and a better sense of this. Thank you so much for joining us, as always, on the Becker Private Equity and Business Podcast. And thank you for your leadership. Thank you very, very much.
Thank you, Scott.